The gold silver ratio, historically, the average is about 55. If you go back all the way back to 1970, it's about 50. It hit 20 in 1980. So there's clearly a lot of opportunity with silver right now. We're probably going to see another black swan before this is all over. They happen with some regularity. A crisis happens every 2 to 3 years. So, there are a lot of reasons to remain bullish on gold. And Trump is only a short-term factor when you look at the big picture for this. So it's a bull market. I'm bullish. I continue to be bullish, and I am investing heavily in that belief.
The gold-to-silver ratio has reached an elevated level of 90, near a decade high, signaling a rare opportunity for silver investors. On a day-to-day basis, gold and silver prices are typically highly correlated, with a one-year rolling correlation coefficient ranging from 0.68 to 0.95. Yet, despite silver's recent strength, the ratio remains far above its historical average of 50 to 55, and well beyond the low of 20 seen during silver's 1980 peak. JeffClark, veteran mining stock analyst and founder of the Gold Advisor, notes that even as silver gains ground, the gold-silver ratio still hovers above 93. This disconnect, he argues, presents significant upside potential for silver and, by extension, silver mining stocks, especially if the market begins to correct this imbalance. On June 27th, spot silver fell 1.81%, snapping a multi-day rally and pulling back from its highest levels in over a decade. Despite this retreat, silver remains up more than 20% year-to-date, suggesting the recent dip is more of a market recalibration than a reversal of the broader trend. While the timing of a silver breakout remains uncertain, Clark emphasizes the magnitude of the opportunity. He points to multiple systemic risks: ballooning debt, persistent budget deficits, rising geopolitical tensions, and the potential for an unexpected crisis, as ongoing catalysts supporting both gold and silver. These conditions have historically driven strong interest in physical gold, and should sentiment continue to shift, could soon ignite renewed enthusiasm for gold and silver mining stocks. Experts expect gold prices to remain elevated amid ongoing macroeconomic and geopolitical uncertainty. According to Titan's latest annual report, these conditions are likely to persist, sustaining demand for gold as a hedge. As Clark puts it, history has shown that major financial dislocations often strike without warning, and today's risks point toward growing investor interest in tangible stores of value. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
The gold-silver ratio, I'm looking right now, it's still over 93 as you and I talk. That's really historically very high. Even though silver is moving more than gold recently, it seems like the gold-silver ratio is still very high. So the opportunity is still with silver. A lot of us have been saying that for years, but it's true. The gold-silver ratio, historically, the average is about 55. If you go back all the way back to 1970, it's about 50. It hit 20 in 1980. So there's clearly a lot of opportunity with silver right now. Obviously, the question is timing. When does all that happen? And no one can really answer that with any certainty. But that's okay. I think you have to have exposure to silver, and I think you need to have exposure to silver equities, because if silver does what a lot of us think it will, these equities are just going to fly. This is a bull market, and the bull market started, in my humble opinion, on leap year day last year. Because the day before, after the market closed, the Fed came out and said, "Oh, we're going to lower rates and more often and more quickly than we thought." And that's since changed, of course. But the next day, gold took off. And if you look at a chart, it's never looked back since then. It's had some corrections, but it's never looked back. It's a very healthy bull market since that date. And since that date, it's up 65%, give or take. GDX is up more than that. And GDXJ, by the way, is up more than GDX. So that's what you want to see in a bull market. The factors are for a bull market. The qualifiers are in place. They're there. This is a bull market. It's not a false start. And I'll say that the average gold bull market is between 2.5 to 3 years. So if we've been going a year and 3 months or whatever, we've got another 1.5 to 2 years to go. So, and that's the average. And I might argue that there's a lot of vulnerabilities in the system right now that are surrounding this that could be very gold bullish. And, it's not just Trump and the things that he's doing. It could be the debt. It could be the deficits. It could be geopolitics. It could be a black swan. Jay, I went back and looked at all the crises since the 1970s. and almost half of them were black swans. They weren't even, nobody was watching for them. Nobody was prepared for them or predicting them even. COVID being a good example of that. So, we're probably going to see another black swan before this is all over. They happen with some regularity. A crisis happens every 2 to 3 years. So, there are a lot of reasons to remain bullish on gold. And Trump is only a short-term factor when you look at the big picture for this. So it's a bull market. I'm bullish. I continue to be bullish, and I am investing heavily in that belief. So it does lead to more demand for gold and gold stocks. And I think what hasn't happened yet, while they're talking about gold, they're not really talking about gold equities yet. We haven't seen mainstream and Wall Street move into gold equities in any real meaningful way anyway. So that's still ahead for us as well. And that's another reason I remain bullish. So a lot of the move in gold has left some gold stocks behind. And, I think there's a catch up there that'll come. So there's lots of reasons to be bullish. And I think there is more demand that is still ahead, especially for gold stocks. We have a royalty company in our portfolio. The one thing when I wanted to add a royalty company to the free newsletter, I started looking around and I realized that, the big four, Wheaton and all of those, they make up the ETF. So I thought, well, if I'm going to buy one of them, I love Franco-Nevada, but if I'm going to buy that, I'm really just going to match what the ETF does, right? So I need something a little different. I need something that has not yet got to that level and yet isn't so brand new that it's going to take years to really get its feet under it, And so I think we found that. And I'm always on the hunt for opportunities like that. I think I've found another one that we'll probably recommend. But, traditionally, Jay, this is a good topic. We talk about this for a long time, but traditionally, royalties have been overvalued. They've been overvalued because they're safer. They're easy ways to play the gold market, the gold bull market. But recently, they haven't been as overvalued. And so I think there's still opportunity there, generally speaking, with royalty companies. I think they're a great investment. And they're not as overvalued as they traditionally were. So, yeah, not a bad. A little bit. Mark Bristow, CEO, he's going to do what he thinks is best. I really like him. I've interviewed him before. I don't really follow Barrick, but they have acquired a lot of copper assets as well. And so they're becoming more of almost a mining conglomerate, if you will, and not just focused solely on gold. So, yeah, I was a little surprised, but they're doing what they think is in their best interests.
JeffClark highlights a notable divergence in the performance of gold and silver stocks this year. While some mining equities have doubled, tripled, or even surged tenfold, others, despite owning ample high-quality resources, have barely moved. This discrepancy suggests that market enthusiasm has been selective. Gold itself has been a standout performer in 2025, as investors piled into the metal seeking safety amid persistent global trade turmoil. Futures reached an all-time high of $3,452.80 per troy ounce on June 13th, according to Dow Jones market data. Although prices have since dipped, with some investors shifting back toward risk-on assets, the broader trend remains firmly bullish. Top-tier miners have benefited from gold's momentum. Newmont's stock is up 59% year-to-date as of Thursday's close, while Barrick Gold and Agnico Eagle mines have also seen substantial gains. However, this outperformance comes with a caveat. Their valuations remain highly sensitive to swings in the gold price. On Friday, shares of Barrick and Agnico Eagle fell 3% and 5.5% respectively, following a decline in bullion, underscoring the sector's inherent volatility. Clark emphasizes that strong due diligence is more critical than ever. He believes that some of the most promising opportunities may lie in the overlooked or underperforming stocks, companies with solid assets and fundamentals that the market has yet to recognize. In a highly bifurcated environment, identifying such value plays could offer substantial upside when investor sentiment aligns with reality. Let's get back to the interview.
What's interesting is we have stocks, and I'm sure all the other newsletter writers do too, including you, that have, doubled and tripled year to date. There's one that's gone 10x year to date, and I missed the boat and couldn't recommend it. Meanwhile, you have some stocks that are doing absolutely nothing, and they're sitting on high quality assets, big resources, or whatever the case might be, and they're going absolutely nowhere. So you have a bifurcation where you have stocks that are doing really well and some that are not. So that implies that it's a stock picker's market, which means you do need to do your own due diligence. You need to pick which ones you think are going to do better. Don't go for the laggards. It also means that the stocks that are lagging, that aren't really moving, and yet they have high quality assets, in my opinion, that's still ahead for them to move. I think once the market takes off as a whole, then we will see those assets that should be priced higher move higher. There might be individual reasons, but the only thing, and I've looked at this, Jay, because I myself wanted to know, okay, what's going on here? Why are these stocks moving and these aren't? And the only thing that I've really noticed is that in some cases, production is being favored. Those companies that are starting production, actually going into production and producing gold, those are being favored. Those are being rewarded, if you will, in the market. So I'm glad we have some of those in there. And some of the ones with the big assets and the big resources that aren't going into production, they're not being revalued yet. I think that re-rate is still ahead, but they're not being valued yet. Well, we've had Snowline Gold in there. That's gone 20x for us, believe it or not, since I first recommended it years ago. And that was all throughout COVID and fears of recession, stock market crash, Trump, all of that. And it's up, I think, maybe 19x for us at the moment. But the one that sticks out right now, the recent one, is Helios Star Metals. That stock has done extremely well. And here's a good lesson. It actually sat there for, a pretty long period of time, most of COVID. And all of a sudden they acquired other assets. They have a very aggressive, sharp management team. They acquired some other assets that were near production. They're putting them into production, and that stock has taken off. So it's done very well for us. It's more than a triple. And I think that's a good lesson there. They have been rewarded, even though they're in Mexico, by the way. Same with Luca Mining. They've done very well. Both those companies are in Mexico, and yet they started production and started actually pouring gold. And I think that's the reason they've been rewarded. We have several of those in our portfolio right now, and I'm excited about them, and they're all moving up. Another one is Erdene Development. Even though some feel like it's a questionable political jurisdiction in Mongolia, that stock has done really well. They're about to start to pour gold here in the second half of the year. So probably still see a little bit higher run in the stock. But there's lots of examples like that. I think that is the line in the sand is, are you going to produce gold in the near term? A lot of companies sitting on big resources, they will produce gold at some point, but that's the issue. It's at some point. And I think the ones getting the love right now are those that are going into production or about to go into production. That for me is a sweet spot. Well, some of the things that we always talk about are still important. The people behind it, obviously. I want not just an experienced team, but a successful, experienced team who's done this before, what I'm trying to invest in. A pro-mining jurisdiction, obviously, is important. And then, my grandma's chocolate chip cookies. You want an asset that's big and rich, It has to be big enough to matter. There are some companies that are in production, going into production in that sweet spot that, they're really small production, or they have a big production, but it's low grade. What it comes down to in terms of grade, by the way, is really economics. The question to always ask is this deposit going to be economic? And low grade can be economic and high grade can be uneconomic, It depends on a lot of factors, metallurgy, etc. So you always want to ask that question. Every press release comes out. Can this asset go into production and be economic? And I think that's a crucial factor right now. A lot have moved, like I like Helios Star, but it has admittedly moved a lot. I probably would look at Radisson Mining as one example of many that I own. In Quebec, new management last year, they've gotten very aggressive. The issue there a year ago was, okay, are they going to go toward development? Because they have a resource. They have a 1 million ounce resource at over 10 grams per ton. Or are they going to continue to explore? I was hoping they would continue to explore and make this thing bigger. And that's exactly what new management has done. I think it's 35,000 meter drill program this year, give or take. They've already reported some results results, but a lot of drilling this year. Stock has doubled for us, but I think there's a lot ahead, and it's one I'm personally overweight. So I think there's a lot more fun ahead with that stock. And then if you want a copper pick, by the way, we just added a new one recently. And I want to tell you exactly about it. So it is Gladiator Metals up in the Yukon, very experienced management, aggressive drilling, getting high-grade copper hits. But there's one thing about this stock that I really like that I don't think a lot of people are aware, and that's this. So there are 158 copper deposits in the world with a headline grade of over 1%. There are only 75 of those that have over 5 million tons of ore at 1%. And of all of those, only 4 are open pitable, meaning cheaper, and 2 of those have questionable political jurisdictions. So if this company can prove up a 50 million ton copper asset with a headline grade of over 1%, which is where it's currently at, by the way, and it's open pitable, they'd be only the 5th one in the world with that qualification. And 2 of those 5 you may not invest in simply because of the politics. So this is a very exciting pick, I think. I think Gladiator Metals are aggressively drilling this summer up in the Yukon. Results are continuing to come out all summer long. So I like them for that reason. I've been actively buying that stock.
The Federal Reserve's 2025 bank stress test results revealed that 22 major U.S. banks maintain strong capital positions, reducing immediate concerns over financial instability and weakening the demand for precious metals as crisis hedges. At the same time, expectations for rate cuts have diminished, with markets now pricing in just a 25% chance of a cut in July. Despite President Trump's continued push for lower rates, rising real yields have further pressured non-yielding assets, such as silver, making them less appealing to investors. This shift has led to a squeeze on speculative long positions that had been betting on deeper monetary easing from the Fed. Only 2 policymakers continue to hold a dovish stance, highlighting a monetary backdrop that appears less supportive of the precious metals rally, at least in the near term. With systemic financial pressures quietly building and policy uncertainty casting long shadows, the conditions appear ripe for renewed attention to tangible assets. Meanwhile, the contrast in stock performance within the same sector underscores a broader truth. Opportunity often hides in overlooked corners, waiting for sentiment to catch up to reality. Is the market's silence around undervalued silver plays a warning or an invitation for strategic investors to move before the crowd catches on? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.